So being in a bear market does give us some benefit, which is the ability to purchase high quality businesses or stocks at a very low price. Although it's a very counterintuitive thing to do, but buying in a bear market is probably one of the best ways to accumulate great assets. So this video is sponsored by habittrade, but more about them later on. So right now in the channel, we've got a crypto portfolio which we are purchasing cryptos every single month, and that hasn't been working out for us.
Not working out at all.
And in current times, I'm adding in more stocks into my portfolio because I want to ensure that my crypto holdings remains 10 to 20% of my net worth, while the majorities are in stocks and bonds, which are safer assets with less volatility. And something I want to stress is that investing don't have to be difficult or expensive because it really depends on your own risk appetite and your financial background. At the end of the day, this video should serve you as a guide, but you shouldn't copy it entirely as well. And hopefully if you keep doing this and make this similar to our crypto portfolio but for stocks, and for this mini series, I'll be putting roughly $100 into different stocks and ETFs, and probably dollar cost average into them and taking advantage of the bear market right now. So let me put it out there that since we are working with $100, there might be some months that we do not completely exhaust everything, and there might be some months that we use up everything. But this will vary depending on the market conditions, and hopefully things will go into our favor. And I guess in the next video for this series, we can add a small little dividend counter at the top corner to see the dividends that we get for the month, as well as the current portfolio value. So if you do want to see that, drop a like button to show that you appreciate the small little things in life. So with a small amount like $100, something that we have to understand is that we cannot expect this $100 to become $1,000 within a couple of months, because this isn't crypto and the stock market is less volatile as well. So with $100, I think the best strategy we have right now is to invest into an ETF that will give us solid dividends on a regular basis without too much upside risk. But before we start purchasing this stock or the ETF, I would want you to understand that this is my strategy and yours might very different from mine. But it doesn't mean that you're wrong or I'm right, it just means that we got different risk appetite and risk tolerance. So let's talk about why I picked this ETF and what are the benefits. So when we hold an ETF, it's like entering a restaurant and having a huge sampler plate where we get to sample different dishes that the restaurant offers. And in this case, the restaurant is the stock market and the dishes are the stocks that are available. With a limited amount of money and appetite, there's only so much food that we can order and eat before we over-order and we end up wasting food. So this is where the sampler plate, like an ETF, comes into play. So we get to have a little bit of every single dish in the restaurant so we know what we like. And the next time that we come back into the restaurant, we can then order the dish that we want. And in this case, it's the different stocks that are available in the market. So that's one benefit of an ETF, because when a company in an ETF doesn't do too well, the remaining companies within the ETF will somewhat support it and push the price up. So some popular ETFs includes VOO, which tracks the S&P 500, we have VTI, which is the total stock market, and QQQ, which tracks the top tech firms. But something to note with ETFs is that in every ETF there will be something called an expense ratio. So the expense ratio refers to the fees that you pay over the course of a year to own this particular ETF. And the other important thing to look out for in a dividend paying ETF is the payout ratio. So when a company pays out dividends, this money comes from somewhere, and chances are if the company is performing, the money will come from the profits that the company makes. If the company isn't making a lot of profit or is on a loss, then the company might reduce dividends or stop paying dividends for a period of time until things stabilizes. So the payout ratio here refers to the percentage of the profit that is used to pay out dividends. And this can be calculated by taking dividends per share divided by earnings per share. And this magic number will then tell us how much of the company's profit is being used to pay out dividends. So ideally, the dividend payout ratio should be somewhere between 50 to 75%, and it varies between the sectors and the industries that the business are in. So having a 50 to 75% payout ratio will allow the business to have some profits, which can be used to innovate or reinvest into a business, and ideally it should churn out better products or services that people value, which can then drive higher profits for the following year. And if the payout ratio is too high or above 100%, this can be very worrisome because it means that the company is not profitable and have to pay out higher dividends to keep investors and shareholders happy. Or they could be taking on debt to finance this dividends payout, which might not be great for the long term. But there is one kind of stock, which is REITs, and this is the type of stock that do have relatively high payout ratios because it's one of the conditions that they need to qualify as a REIT. So for a company to qualify as a REIT, there are quite a few requirements like paying out 90% of their taxable income as dividends each year, be an entity that will be taxable as a corporation, have a board of directors or trustees to manage, and shares must be fully transferable, and much more. And I think we can talk about this in another video. So for today's stock and ETF purchase, we'll be buying one of my favorites ETF, which is SPHD. Because we only have $100 to work with, this ETF seems to be one of the best ETF to have at this price range. SPHD is Invesco S&P 500 High Dividend Low Volatility ETF. This fund will invest 90% of the total assets in common stocks that comprises the index. So the S&P actually compounds and maintains and calculates the index, which is then composed of the 50 securities traded on the S&P 500 index that historically has provided the highest dividend yield and the lowest volatility. The fund and the index are then rebalanced and reconstituted semi-annually in January and July. But if none of that made any sense, just understand that SPHD tracks the top 50 paying dividend stocks in the US. To understand more about this ETF, let's look at the top 10 holdings of the ETF. So the top 10 holding based on percentage, we can see some big names which I personally know as well, like Chevron Corporation, which is an oil and gas company. We have Ultra and Philip Morris, which is in the tobacco business. We have IBM that does computers. We have Verizon, which is a telecommunications company. And we have Kraft Heinz, which does our ketchup. So SPHD currently has a dividend yield of roughly 3.95% and an expense ratio of 0.3%, which is very manageable. And one of the reasons I like SPHD and selected them because they pay out dividends on a monthly basis, which then gives us cash flow, because as a smaller account, having some cash flow can greatly boost our cash positions during the bear market, and hopefully this will bring us some great yields in the time to come. And to buy this ETF, it's really simple, and today we'll be using habittrade. So if you haven't gotten an account, I'll leave a link in the description down below where you can sign up and get started. And one of the benefits of habittrade is the ability to use stable coins to start purchasing stocks, which is a great way to diversify your investment portfolio. So once you are in the app, we'll click on the trade tab, which will bring us to our accounts and we can start purchasing. So because I'm gonna purchase this on a monthly basis, I'm not too worried about price differences that the stock has, so we'll just do some market buys. And to do that, we can use the flash trade options. So once we click on flash trade, we will search for SPHD under the symbol, and with $100 we are able to purchase 2 SPHD stocks or ETF, and by purchasing 2 of it, we'll roughly get 14 cents per month or $1.68 per year per share. So this might look like a very small amount of money right now, but when you couple it with other dividend stocks, this can snowball into a rather large amount. So right now, we do have a little bit of money left in our account, which we'll keep for the next month's purchase. And if you have any stock in mind that you want me to purchase that is within the $100 budget, share it with me in the comments down below. So thank you guys so much for watching today's video, and thank you habittrade for sponsoring today's video. Don't forget to drop a like, subscribe if you haven't, and I'll see you in the next one.